Okay, good afternoon, everybody. Good afternoon. I'm Alan Bleiner, a professor in the economics department and the Woodrow Wilson School. And it is my privilege to introduce to you tonight and then converse with her the first Anna and G. Mason Morfit class of 97 distinguished visitor, and she is indeed a distinguished visitor, setting a high bar for those that will follow as the second annual and the third annual. My friend Mary Schapiro. Let me tell you a few things about Mary, and then we will sit down and talk about some of them. As probably all of you know, she was the well, you probably don't know it was the 29th. She was the 29th chair of the U.S. Securities and Exchange Commission, serving in that capacity from the beginning of 2009 to the end of 2012. You can probably guess that she was the first woman to hold that post, but not the last. And she was also, not incidentally, she is also, not incidentally, and she may be the only one ever to do this, who knows, to chair both the SEC and the CFTC, the Commodity Futures Trading Commission, the two. The United States being the United States, we have to have two security regulators. One's not enough. For us, only Mary Schapiro has chaired both of those organizations. Prior to that, she was the chairman and CEO of what the industry calls FINRA, the Financial, I have to read this, Financial Industry Regulatory Authority, FINRA, which is the self-regulating organization of for broker-dealers and exchanges throughout the United States. A very, very big deal indeed. I want you to think just for a second about the timing of Mary Schapiro's taking over the Securities and Exchange Commission at the end of January 2009. Try to remember what conditions were like in financial markets in 2009. And in case you've forgotten some of it, Bernie Madoff had been arrested 4 weeks, I think, earlier, or something, on top of everything else. In that environment, Mary Schapiro took over the helm of the Securities and Exchange Commission. In her testimony or confirmation hearing, she partially and correctly, I might add, blamed the financial crisis on deregulation or lack of regulation, telling senators that the regulatory system, quote, had not kept pace with the markets and the needs of investors. An understatement, but certainly very, very true. And she promised to press for tighter regulation, including over derivatives, which she has delivered, which she did deliver in the job, although this remains unfinished business, some of which I think we will touch on now or shortly. Last, I want to mention something that I learned from her Wikipedia profile. You got to watch what's on this. You may not know this yourself, I don't know. But according to Wikipedia, and there's a footnote, so it's true. In 2009, she was ranked by Forbes as the, I want you to pay attention to this, 56th most powerful woman in the world. Now, these are kind of precision, and I'm not going to ask you to tell me who the first 55 were, but it's my pleasure to introduce Mary to you tonight. Are you going to say a few words first?
I was going to set the stage for us a little bit.
Yeah, do you want to do that from here? Yeah, why don't you, and then we'll take the seats.
Thank you very much, Alan. Wonderful introduction. And it's a pleasure to be here, and particularly a pleasure to share the stage with you. I admire so much the work that you've done. And as Alan said, we're going to have a conversation and an interview format, but I thought it would be helpful, we thought it would be helpful if I took a few minutes just to set the stage. So as you heard, I was privileged to serve as the 29th chairman of the Securities and Exchange Commission, one of the original New Deal agencies that was created in 1934 to try to restore confidence and integrity in the securities markets and in exchanges. And I assumed my position in January at what was 2009, as Alan said, at what was clearly a low point in the history of the agency. So think back, we were recalling Madoff, who was arrested shortly before I was sworn into office, and just a week before I was announced by the president-elect to be the chairman of the agency, and all I could think of was, what have I done to myself? But also, the 5 largest investment banks regulated by the Securities and Exchange Commission had failed during the crisis or been sold or had to convert to bank holding companies. Lehman Brothers and Bear Stearns had failed, Merrill Lynch had been sold, and Goldman Sachs and Morgan Stanley had been converted into bank holding companies. And these were entities that were the responsibility of the SEC. And as I said, Bernie Madoff, we had just learned, had stolen $60 billion from investors. So my timing was just awful. And you would be excused actually hearing this for wondering whether there was any reason at all for this agency to continue after 70 years or so of history. 75th birthday was actually in 2009. Why on earth, given this track record, do we need and do we want and should we keep a Securities and Exchange Commission? And I can tell you there are 160 million reasons. And that's how many investors we have in the United States. And whether they fully understand or not, and despite the agency's bad stumbles, those investors are highly dependent upon the SEC. There is a centrality to the SEC's role in our markets and in having a successful economy. And I think that is really indisputable. So in simple terms, of course, equity or stock markets support our economic growth. They allow investors to allocate capital to companies to create jobs and manufacturing and products, and then through their returns allow that money to cycle back to investors through capital, as in the form of capital gains or dividends. And equity is particularly well suited in a country like ours where we place a high value on innovation and risk-taking. And this is so because equity only has a residual claim on the earnings of a corporation. There's no right to a dividend, but if you've invested well and the company has done well, you may expect to get that dividend. And of course, you have the ability to sell your stock if you think the company's headed in the wrong direction, or to acquire more in the secondary market if you think it's if it's doing well. You can exit or increase your stake at any time. And so these markets are really critical to the growth of this country. But critical to all of that, none of that works if we don't have investor confidence, and that's really where the SEC comes in. The role of the Commission is to ensure that investors have confidence in their ability to reasonably allocate capital. And the foundations of that investor confidence, for which the SEC really has a sworn responsibility, are transparency. Investors have to be provided with information that's complete and timely and honest, quantitative and qualitative, that allows them to make rational decisions about where to invest. They require accounting that is rigorous and transparent and not subject to political whim. The markets need and investors will demand well-developed standards of corporate governance. Shareholders, those who own the corporation, have rights. They have to be able to exercise those rights, and those rights have to be protected by law. The financial intermediaries, whether those are brokers or mutual funds, have to be competent, financially strong, and honest. We need honest gatekeepers, and those are the accountants and the analysts and the lawyers who protect our capital markets right alongside the SEC. And finally, the market structure. The systems for trading and clearing and payment and settlement of securities transactions have to be resilient and reliable. And all of these pillars of investor confidence require a vigilant, informed, and expert regulator who promotes investor protection and a level playing field, including vigorous enforcement of the law and the rules. So from my perspective, when I arrived at the SEC in January of 2009, the SEC was very much an agency worth rehabilitating and strengthening. And we moved very urgently to do several things. One was we had to take clear accountability for our failures. We had to take accountability for having missed the Madoff fraud, despite having evidence inside the building, tucked away in different silos, that something very, very wrong was happening with his firm. We had to build a new team because at the end of the prior administration, lots of people had left. I needed a new team and new senior people, but we also needed new skills and training. The SEC is a very lawyer-centric agency, as you would expect from a law enforcement agency and one that writes rules. But we needed people who understood trading, who understood financial analysis. We needed quants. We needed economists. We needed lots of different talent. And we needed an investor-focused agenda that would really put first and foremost on our plate efforts to protect investors and level the playing field. We needed better cooperation with our fellow regulators. And we needed to reorganize to become much more efficient and effective in what we do. We had to introduce technology. We needed resources that we pleaded for Congress to give us. And we needed aggressive enforcement of the laws to ensure that people would be held accountable for not just the financial crisis, but for all the other things that can go wrong. So that's how I started out 2009. That's how I hope I carried on through the end of my tenure in 2012. And with that, I'd be happy to join you, Alan, and answer some questions.
Yeah. Thank you. You should sit first.
Thank you. That doesn't happen in Washington.
No, in fact, they rushed for the seat.
Right.
Someone would have taken your seat.
Exactly, pushed me out of the way.
So you have answered this actually in the opening remarks, but given the situation you were walking into when President Obama called you to offer you this job, why didn't you say no? Well, no, thank you.
No, thank you, right. Well, you know, it's awfully hard to say no to the president when they say, we need you, your country needs you. That's a pretty compelling thing. Even though you know he says it to everybody, it still makes you feel pretty special. And you know, I had been at the SEC as a commissioner from 1988 to 1994 and served under 2 Republican and 1 Democratic chairmen. And I had tremendous affection for the agency. In those days, the SEC was considered the crown jewel of the federal bureaucracy. The people were smart and talented and quick and very, very expert. And it was a very exciting and interesting time to be there from 88 to 94. And the opportunity to go back as chairman and really lead the agency, and hopefully, having watched it lose its way a little bit, to help it find its way again and reconnect it to some of the things it had done in earlier days that had worked out so well. So it was very hard. It was impossible to say no, and I was very honored to be asked. At the same time, I had many moments of what have I done to my life. My children were still in high school, and I never saw them basically for 4 years. And there were lots of issues within the agency. There had been severe underinvestment, for example, in technology. I left in '94, and I got there in 2009. The technology was essentially the same. And there was just a lot to do, but I thought I could make a difference. So I said yes. And then curled immediately into the fetal position under my desk. But I came out eventually.
Well, we're all glad you did. Not the fetal position, but that you did. In answering that, you mentioned you served under Republican and Democratic SEC chairs. Unlike, say, the Federal Reserve and a number of other agencies, SEC commissioners have political labels.
Right.
Democratic members, Republican members. Do you think that's a good thing?
Yeah, I have mixed views about it. I think group decision-making can be very effective and often lead to a better result. And I think bringing people with different perspectives together to solve a problem is almost always a good thing. The law requires that there are 5 members of the Securities and Exchange Commission, and then there's 4,000 staff underneath them. But those 5 people who vote on the rules and the enforcement cases, the law requires that no more than 3 be from the same political party. And the idea would be that you wouldn't get dramatic swings in Republican and Democratic administrations because you always have a mix of perspectives. And so on balance, I think it is a good thing. I think as Washington has become more politicized, these independent agencies, and there are others that have the same structure, have also become a little bit more politicized, and it makes group decision-making a little bit harder. But I like to think that I'd like to believe it helps pull things towards the middle a little bit more, but sometimes people get staked out pretty far on the extremes.
Yeah, and a lot of 3-2 votes.
Yeah, not as many as the press would like to portray, but certainly on some controversial issues, we've had 3-2 votes at the SEC. CFTC had many, many 3-2 votes.
Yeah.
They have the same structure.
Yeah. So you came into office at the height, more or less, of the financial crisis. A lot of things, bad things, had happened already. Quite a few people have observed, I'm one of them, but there are many, many others, have observed that to a first approximation, nobody went to jail for all of this bad behavior. I realize that it wasn't your job as head of the SEC to put people in jail. That's other people's job. But as an observer, as a very close observer of what happened, why do you think it was that essentially nobody went to jail?
So I truly understand the frustration with nobody at senior levels has been effectively, in many people's minds, held accountable. I will tell you the SEC, something in the range of 150 to 160 cases were brought by our enforcement division arising directly from the financial crisis, and some 60 or so CEOs, CFOs, or other senior managers were named in those enforcement cases and subject to paying fines or court injunctions, or in some instances deprived from the ability to ever serve as an officer or director of a public company again. So that's not an insignificant sanction. Of course, the SEC is a civil enforcement agency and can't bring a criminal case and can't put people in jail. And we always look, whether it's financial crisis cases or other kinds of cases, we always look to try to find the individuals who can be held accountable and not just name the companies. But given the requirements to prove intent and scienter, and given the complexity of some of these firms where there are many decision makers in a process that contributed to a bad result, it was sometimes very hard to have the evidence and prove those cases. I think the Justice Department has also really struggled with this and the ability to try to bring, appropriate criminal cases against individuals. And so, while I said I do understand the frustration with that, I can assure people it is not for a lack of desire to do that and to name individuals and to hold them accountable. Obviously, companies act through their people. And so individual accountability is important.
No. You don't want to. No, never mind. You don't want to say the Justice Department fumbled the ball.
I would never speak ill of a fellow regulator.
Right. One of the things that very early on, or right after Lehman, contributed to the virulence of the financial crisis was the run on the money market mutual funds. That led many people to see that, well, obviously, the people in charge at the time saw that as a major systemic risk that had to do something about quickly. That issue of the systemic risk from money market mutual funds continues to this day. It reverberated throughout your tenure. Some of the memories of that, I'm sure, are not that fond memories. Would you tell the audience a little bit about that and where it is now as opposed to where you think it should be?
Absolutely. So this is, to me, major unfinished business from the financial crisis. In September of 2008, a money market fund called the Reserve Primary Fund broke the buck. And what that means is they had to reprice their shares below that stable $1 net asset value that we've all come to expect from money market funds. Reserve was a $62 billion fund. It held about $760 million of Lehman Brothers commercial paper. And when Lehman Brothers failed, they had to reprice that paper, and it caused them to drop significantly below $1. And you're allowed to maintain this accounting fiction if you're close enough to $1. The SEC actually lets you say the value of a money market fund share is $1, even though it might in fact be less. And, but they dropped so far below that they were no longer allowed to maintain that fiction, and they had to reprice. That terrified people who had money market fund holdings, and it precipitated a run on money market funds because you would go quickly to get out at $1 when you know the portfolio could be less than $1 over time. So that run spread to other money market funds, and within 1 week, $300 billion was pulled out of money market funds. The effect of that was to completely freeze the short-term credit markets because money market funds held 40% of the commercial paper in the United States. And money market funds couldn't roll that paper over because they needed to hoard cash in case their investors wanted to get out and redeem their shares. And as a result, the short-term credit markets were completely frozen up. Companies couldn't roll their paper. And the situation was quite dire. If you read Henry Paulson's book, who was Treasury Secretary at the time, he says this is one of the single most frightening moments of the entire financial crisis for him. So Treasury very cleverly designed a guaranteed fund for all money market funds. It lasted 1 year, and if you already owned a money market fund, at the time Reserve broke the buck, you were guaranteed by the federal government, also known as all of you taxpayers, that you would get your dollar back out, even if the fund's shares were actually worth less. And the Fed created liquidity facilities as well. That stopped the $300 billion, after that outflow, that stopped the run. The credit markets returned to normal. Money market funds didn't have to dump their assets into a fire sale situation, and the markets stabilized. But that brittle $1 net asset value really creates a run risk. And institutional shareholders will always be better equipped to run and run quickly and get the dollar, and then losses will be concentrated among all the rest of us who are retail investors who don't have the same capacity to get out. So my view was, while the SEC, we did some very good rules in 2010 that helped to stabilize money market funds, particularly during the European debt crisis. No funds broke the buck. It wasn't enough. What we did essentially was improve their credit quality, shorten their maturities, require stress testing, and some other things. But the answer is, to my mind, one of two possibilities. One is mark to market and value a money market fund at its real price. Whatever the underlying assets are worth is what the money market fund share should be worth. That to me seems like the logical and the right answer. The alternative would be, if you want to keep a $1 stable value like a deposit account has, then there ought to be some capital behind that. And the capital can be used to absorb the small day-to-day fluctuations and losses. I convinced virtually every regulator, except my own at the SEC, and the bank regulators agreed, the European regulators agreed, but my fellow commissioners, not enough of them agreed for us to pursue these more dramatic changes to the money market fund industry. And as a result, the SEC has proposed something recently that's not quite, well, it's not close to what I had originally proposed, but it still remains for work to be done in this area because we're at risk. You know, the way it played out over my 4 years was quite interesting. Industry opposed this very dramatically and very strongly, which is why we couldn't get it finished. But when you might recall when the Fukushima nuclear reactor in Japan blew up, the first question we had at the SEC was, what money market funds are exposed to Fukushima or exposed to Japanese banks or to Japanese sovereign debt that might be affected by this very dramatic and very unfortunate incident? And so money market funds are affected by activities all around the world that we don't even think of as having an impact on our investments, but in fact they do, and that's why the run risk is such a concern, because almost any event could trigger a downgrade in the quality of the paper and a revaluation.
Right. So you just see any reasonable prospect we're going to get something done that matters about money market mutual funds? This is at the top of the list of a lot of people's worry list about systemic risk.
Yeah, it really is. And so when the SEC didn't act, I asked the Financial Stability Oversight Council, which is the umbrella organization of financial regulators, to take a look at the issue, because collectively we have responsibility and accountability for the systemic, for the safety and soundness of our entire financial system, and this is an issue that went right to the heart of that. So actually, the FSOC, as we called it, published the proposals that I had, put those out for comment, mostly as a way to keep light shining on this issue. and keep it in the forefront. The right agency to do this is the SEC. It's the expert agency. Subsequently, the SEC came out with some proposals that are a partial step. I don't know if they'll adopt them finally. I don't know if they will answer the fundamental concern about run risk, but so we'll have to see how that plays out over the coming year.
Now, the way the FSOC, and I'll just very short on this and then we'll get on to another question. The way the FSOC works, and according to the FSOC's charter, you're a member of the FSOC, can the FSOC overrule the SEC?
It would be difficult in this case. The FSOC has the ability to push the agency. They could designate as systemically important financial institution individual money market funds. That might be a hard case to make because an individual money market fund is really not that big. The other alternative, if they chose to do it, would be to designate the money market fund industry as a systemically important process or system. They haven't done anything in that area yet, but that would be their other alternative at this point, yeah.
Okay. Let's change a little bit. The main regulatory change or set of changes that came out of the crisis was the DoddFrank Act of 2000. As you look back at what was being debated, 2010, sorry, I said 2010. During 2009 and the first half of 2010 until the act was finally passed both houses and was signed by the president, and you were sitting there as chair of the SEC. How did the SEC do in getting what it wanted and preventing what it didn't want?
Well, so from an agency that was really kind of on its knees in 2009, and in fact, early versions of the administration's plan for regulatory reform called for eliminating the SEC. But the reality is the functions of the SEC, as I said earlier, are absolutely critical to our economy and to our financial system. So you would have to put those functions other places anyway. But we went from that point to actually gaining much more responsibility and authority in several really important areas. So, for example, hedge funds. Going into the financial crisis, the SEC did not even know how many hedge funds were out there. Didn't know their trading strategies, didn't know counterparties, had very episodic amounts of information. And so one of the things we asked for in DoddFrank was the ability to register hedge funds and get basic reporting about their activities, both for investor protection purposes, but also for systemic risk purposes. We also asked, coming out of the Madoff debacle, for authority to reward whistleblowers who brought us credible information about securities law violations, in part so we would pay closer attention to the people who came in the door. And we were able to get that authority. We shared with the CFTC authority over over-the-counter derivatives. SEC has a small piece of that. The CFTC has the lion's share. But that's another huge addition to our responsibilities. And then there were sort of cats and dogs, we used to say, smaller items that were important for financial reform in the asset-backed securities area, the municipal securities area, that were also given to the SEC. So on balance, about 100 new rules had to be written by the SEC coming out of Dodd-Frank.
So you came at a more powerful agency
a more powerful agency in terms of responsibility, not quite resourced well enough to really do the job that needs to be done.
Right. Yeah, which is the way Congress can give authority and not quite give authority.
Right.
Yeah. Apropos of that, that's a natural lead-in to the question. I'd like you to explain a little bit to the audience why it has taken so long to get the Dodd-Frank regulations written so that implementation can actually start. Paul Volcker was here not very long ago, and I can tell, he's not that thrilled that it took 4.5 years to translate the Volcker Rule, which got enacted in the middle of 2010 into implementable regulations. That's just one example.
No. And so Volcker was particularly complex and was a multi-agency undertaking. I would say, look, we're coming up on the 4th anniversary of Dodd-Frank. A number of things are in place, and it's terrific that they are. The over-the-counter derivatives regime is largely in place because of the CFTC's hard work. SEC's piece of that is lagging behind for sure. As I said, the hedge fund registration's in place. A lot of the bank agency rules are in place. But on balance, everything isn't done for sure. And I think the reason is manifold. One is just the sheer volume of rules that needed to be done. 100 at the SEC. And while we have a lot of staff, we didn't have expertise in every area. And the funnel gets pretty small. It all has to go through 5 commissioners who have to be able to read and understand and dissect, 500, 600, 700-page rule releases. So the sheer volume was extraordinary, and the time frames that had been put on a lot of the rules and legislation were clearly unrealistic. Second is just the complexity. If you look at something like the over-the-counter derivatives market, the credit default swap market, for example, or interest rate swaps and other swap products, it's complex, but it was also a $600 trillion market that already existed. And we were in the position of having to create a regulatory regime to impose upon an existing market. That's a lot harder than having a regulatory regime that grows up with the market. As it becomes bigger, the regulatory regime just adapts. It had to be created whole cloth. The third thing that I think made it harder to get things done was a bunch of rules, including the Volcker rule, but also some executive compensation rules and asset-backed securities rules had to be done by multiple regulators. We all had to come up with the same rule. So everybody's got a different perspective, everybody's got a different legal foundation at their agency, everybody had a different set of priorities about what they thought was the most important thing to do first, and that multi-agency participation just takes a long time. And the other thing I would say is that there were rules in areas that were so important for us to also engage industry and understand their perspective. I mean, we have a process in this country where the people who are going to be affected by rules have a right to share their views with the regulators. And we had some rules where 10,000 comment letters, Volcker's a good example of that, were sent into the agencies. Well, somebody has to read all those. They don't just come in and we say, isn't this great, we got 10,000 comment letters. We got to read them. They have to be synthesized. And the consideration has to be given to whether the points the commenters are making are so good and compelling that we should change the rule that we proposed to accommodate those comments. So
you might mention, by the way, that these 10,000 comment letters weren't like one paragraph each.
Oh no, some of them could be 100 pages long. So the sheer volume of outreach to industry, outreach to investors, outreach to academia, comment letters, meetings, caused the process to drag on very dramatically. One of the things we wanted to do at the SEC is we always said industry knows exactly where to find us. They know how to get their perspective to us through their lobbyists and their representatives and their comment letters. We actually want to make sure we also reach out to people who don't traditionally comment on SEC rule filings. Let's reach out to investor advocates and others to see what they think is important when we're considering derivatives or we're considering municipal securities issues or whatever. So all of that also took a lot of time. So just the sheer volume of work was extraordinary.
Just a quickie. How much faster do you think it would be if it was one agency per rule instead? You mentioned up to 6 agencies sometimes.
Oh, in some areas it would have been a lot faster, I think. And Volcker rule is probably a good example. The agencies had genuinely different views about, a bank has a very different view about what market making is than a brokerage firm who's, that is significantly involved in market making. So I think things would have been much quicker if a sole agency had responsibility.
Okay, one day we'll explain this to the Congress. Speaking of the Congress and also of derivatives that you were mentioning extensively a moment ago, I and many others have labeled the Commodity Futures Modernization Act of 2000, which, for those of you who don't know, actually banned, never mind it didn't regulate derivatives, it banned the regulation of derivatives as a major cause of the financial crisis. Do you agree with that, and why do you think it ever became the law of the land?
Well, the CFMA did exactly as you say. It prohibited the regulators from regulating over-the-counter derivatives, and of course they grew at an extraordinary pace after that, with no transparency, without central clearing, the things we've come to expect in our equity and options markets and futures markets, all those protections around business conduct standards, central clearing, exchange trading, price transparency, and regulatory oversight were non-existent, and they were clearly major contributors to the financial crisis. You know, I don't really know what animated Congress in the Commodity Futures Modernization Act, but my guess is that it was a complex area and the industry was very persuasive, that it really was sophisticated entities engaged in this activity, and there wasn't really a need for regulation. Before DoddFrank was DoddFrank, and we were, as a community of regulators, but particularly the SEC and the CFTC, talking about what should be the highest priorities for financial regulatory reform, the number one issue on both of our agendas was bringing over-the-counter derivatives under the umbrella of the regulatory regimes of one or both of the agencies.
Yep, well legitimate. A follow-up question. If you had the power, and you didn't quite have this power when you were heading the SEC, though you had an influential voice, would you force virtually all of these derivatives to be standardized and traded on organized exchanges, like put and call options on New York Stock Exchange shares?
Know, I think we didn't have the power probably to do that, and there may be decent arguments for why there have to be some bespoke products that are so unique because an end user or a commercial entity needs a very particular type of product to hedge its risk. So I guess I wouldn't say that there's never a legitimate reason for a non-standardized product. But clearly one of the goals of the legislation was to encourage standardization as much as possible, to encourage central clearing so that there would be a central counterparty and we could reduce the one-on-one counterparty risk that existed and was so problematic during the financial crisis. And of course, exchange trading gives you transparency and price transparency that's enormously beneficial to market participants to understand if they're paying a fair price for a product that they're buying. These things have worked enormously well in the equity markets, and we have very vibrant and healthy and transparent equity markets. When I was at FINRA, we developed the TRACE, the corporate bond reporting system, and the transparency that came to that market was hugely beneficial to investors. So I'm an enormous believer in transparency cures a lot of evils.
Yeah. Yep. So am I. Another problem you faced while you were sitting in that chair was the so-called flash crash of, I'm sure you remember it very well.
I remember it well.
For those of you who didn't, it was May 2010 when a bunch of, well, I'm going to ask you to explain. I was almost going to try to explain it myself.
You probably do better than I would.
No, you'll do better than I would. But what I want to ask you is, given how fast trading already is, do you think there's any marginal benefit left in making it faster and faster and faster? And more generally, do you see a lot of value in the extraordinary turnover we have? These are related on these markets.
So these are hard questions. The flash crash, by the way, was a very sad day in the history of U.S. markets. It was, as Alan says, it was May 2010, and as a result of some trading activity that actually started in the futures markets and then reminding us that markets are interconnected, and then radiated into the equity markets. Great companies listed on the stock exchanges. Some saw their prices go from $30 or $40 a share to a penny, and then quickly rebound. And you can read on the SEC's website the diagnosis that took us several months to, working with the CFTC to compile, that explained exactly how the trading mechanisms worked that allowed this really terrible aberrant algorithm, essentially, to inflict this pain and damage on our markets. And we moved very quickly after that to put some protections in place, like single stock circuit breakers and limit up, limit down, so stocks couldn't move more than a certain amount from trade to trade. coherent rules about when trades would be broken, so people would be, their trades would be canceled if necessary, and a variety of things that I think were really important. But it begged the bigger question of what is the quality of our markets, and does our market structure, which is highly fragmented, you know, the New York Stock Exchange trades a small percentage of the volume of stocks that are listed on the New York Stock Exchange. They trade in lots of other venues, probably close to 75 different places, including dark pools and internalizers and electronic communications networks and all sorts of places. And so we have a highly fragmented market structure, which has made high-frequency trading a very profitable business. And so there's a part of me that wishes they would just get to the speed of light and then we could stop the arms race on faster and faster trading, presuming the speed of light is, in fact, as fast as they can go. Because, you know, extraordinary sums of money have been spent to gain that one more nanosecond of advantage. At the end of the day, I don't think we really know what the impact of high-frequency trading is on the markets. You have a sort of gut feeling that it's not all good. The academic research is all over the place. There are those who say it provides liquidity to the markets, and for those of us who are not interested in microsecond trading, but rather are buy and hold investors, the liquidity that's provided is a good thing, and the costs of trading have never been less, and that's a good thing. On the other hand, there are those who feel that they take unfair advantage of investors, that this ability to co-locate so they get you know, more time advantage is fundamentally unfair. So how do we figure out what to do, if anything, to do in this space? And so when I was chairman of the SEC, we started to acquire data from high-frequency trading firms, massive amounts of data, to analyze, to try to understand the quality of our markets. And that data is actually now publicly available. My successor, Chairman White, has made it publicly available on the SEC website for academics, for the public, to actually look at and work with to see if we can come to some conclusions about what the quality of our markets is. But this fragmentation issue is important. A lot of trading doesn't happen in a transparent way, and I just finished saying I think transparency is the single most important thing we can do for the integrity of our markets, but we have a lot of trading that doesn't happen in a transparent way, and I do think that's problematic.
Go ahead.
I was just going to say markets, one of the most important functions markets provide is price discovery. They help us bring together buyers and sellers and arrive at a price that people can agree is the fair one. If that doesn't happen in the light of day, and if participants don't come together to engage in that price discovery function, something's lost.
What about the slightly broader but broad, longer time perspective dimension of just turnover? There's huge turnover in New York Stock Exchange and other shares and in other assets as well, even when you don't worry about nanoseconds.
Right.
Stocks, you know, funds that have 300% turnover rates and shares that get traded 89,000 times in a year and things like that. Do you see value in that?
I'm sure somebody sees value in it, other than just generating revenue
Yeah,
for the
there's
trading
lots of value in
firms.
commissions in that.
You know, I'm not sure that I do, and you know, it's one of those issues that the SEC you know, clearly needs to study. You know, the level of, you know, more than 90% of orders are canceled and never actually are even executed transactions, and that's an area I think that needs to be looked at. The proliferation of order types that are created to suit particular market participants' needs, I think have added complexity and confusion to the market. So I think there's plenty for the SEC to be focused on here. And the good news is they are focused on it, and they, I think, will, over time, come up with some things that hopefully will make our market structure more stable, including, for example, holding accountable people who let loose algorithms into the marketplace that damage the market and damage innocent bystanders, as we saw during the flash crash.
Do you have a view on the advisability or lack thereov of small transactions tax, financial transactions tax?
No, I always
I'm
used to
going one step further
I
down the
used to
same
always
line.
say to Congress, above my pay grade, I don't get involved in tax policy, and that's a safe thing to do.
Right.
I mean, we'll be able to see what happens, excuse me, in Europe with the transaction tax. And, you know, I've heard all the arguments on both sides, but I guess, you know, it's not clear to me. I actually gave a speech once where I threw out, how about a tax, a fee on order cancellations? And, you know, I nearly didn't make it out of the room alive. So I'm going to leave tax to the tax policy people.
Okay, but just, I'll accept that answer, but I'll remind you, you're now just a private American
Right.
citizen. Nothing is above your pay grade. Another issue that has come up, that came up while you were heading the agency and is still up, is the fiduciary standard.
Yeah.
There are a number of people that think broker-dealers should have to abide by, if not exactly the same fiduciary standard that applies to investment advisors, an analog to it. Do you think that's a good idea, and why hasn't the SEC done anything about it?
Well, I do think it's a good idea, and it was the SEC that asked for the authority in the Dodd-Frank Act to apply a fiduciary standard to broker-dealers if the agency determined that was appropriate. So we wanted to make sure we had the legal authority to do it. So broker-dealers are salespeople, and when they recommend a security to an investor, it has to be suitable for that investor in light of their sophistication and their risk tolerance and their investing goals and so forth. An investment advisor is a fiduciary, and they have to put the investor's interest first. And so there's a distinction there. Maybe it's subtle, maybe it's not, but there's a difference. On the other hand, broker-dealers are highly regulated. There's lots of rules around how they conduct sales and how they interact with their customers, and there are relatively fewer rules around investment advisors because of the fiduciary standard. So the debate is, should broker-dealers also have a fiduciary duty? And I believe they should. And should investment advisors be a bit more regulated the way broker-dealers are with more specifics? And I think there are probably some appropriate broker-dealer rules that ought to apply to investment advisors as well. So it's an amazingly controversial issue in some quarters. But I think Mary Jo White, the SEC chairman, has said as recently as last week that they're going to make it a priority to make a decision. She didn't say what the decision would be, but that they will make a decision on this issue sometime in the next few months. And I hope that they will go forward with the adoption of some kind of fiduciary standard.
Just a quick sidebar to that. I'm staring right at Joe. The normal way you think of that is for retail investors, which is exactly what you made reference. But what about non-retail investors that might not be very sophisticated, like municipal treasurers or
Right.
something, who know the difference between a stock and a bond, but as you go deeper, it starts fading?
So DoddFrank actually tried to deal with that and created a special class of investor who we wouldn't normally think of as retail, just as you say, a municipality, and tried to build in some protections for the advice that those kinds of investors would get to help protect them from, we saw some really tragic examples of municipalities in particular that were advised by a dealer who also sold them very complex derivatives that did not perform under a changing interest rate environment with the way the municipality expected them to. And you know, we can think about what happened in Alabama in particular, and had tremendous, tremendous losses. And you know, that's a tragedy because that affects every taxpayer in that municipality. So one of the goals of Dodd-Frank was to try to ensure that there would be better protections built in for those investors.
And is that implemented?
It comes in different pieces and in different rules, but some of it is yes.
Yeah. Okay, because after all, municipalities are us.
Right, right.
It's just standing in for taxpayers. I got one more last question, then I want to leave time for questions from the floor. We've spoken about the FSOC a couple of times, and you were a charter, not just a member, a charter. You were a member of the first FSOC, which will, of course, go down in history,
Yes.
like the founding fathers and mothers.
Right.
How do you think it's doing so far? And in particular, is 10 too many? That's the number of members of the council.
It's pretty big. So we have all the federal financial regulators, and we have the Treasury and the Office of new Office of Insurance at the federal level, and then we have a representative of the credit unions, Federal Housing Finance Agency, the state securities regulators, the state banking regulators, and the state insurance regulators. It's a pretty big table when the FSOC gets together. I think it's too soon to tell too much about it, but I think there are some very positive things about FSOC. One is that leading up to the crisis, the level of coordination and communication among the financial regulators was not what it needed to be. And I have been told by people that in some cases they didn't even know who to call at a sister agency when they had a concern or an issue. That is clearly not an issue anymore. The deputies to the principals at FSOC work together all the time. The agencies are much tighter in their coordination and their communication. That's a huge positive that's hard to measure. FSOC also puts out an annual report of risks to the financial system, and I think that's a tremendous exercise where everybody really thinks about what are the risks in my part of the market and what are the implications for other regulators in their parts of the market. And that annual risk report, I think, is really a valuable exercise for the financial regulators generally. The other big thing FSOC does, though, is it designates SIFIs, or systemically important financial institutions. For example, GE Capital or Prudential Insurance or AIG, who will be subject to heightened prudential regulation by the Fed in addition to their primary regulator. And they also designate important financial market utilities like the clearinghouses or the payment systems. And they will also be subject to heightened prudential standards. And I think, you know, that process is underway, and I think it's too soon to tell because we don't really have the heightened standards yet, how effective that will be. But I think it's a good mechanism for the agencies to talk about those institutions that we need to be really focused on because they have the potential to be systemic.
Right. And you might add, correct me if I'm wrong, but these institutions hate to be designated SIFIs.
Yes,
they're not clamoring for the honor.
It's not an honor. It's going to be a lot more work and a lot more effort. I serve on the board of General Electric, and we own GE Capital, which has been designated as a SIFI. And I can see just extraordinary work that's going on to get ready for this.
You probably know there was a huge debate among economists at some members of Congress about...
would it be a benefit?
Yeah, that companies would want to be... Being a SIFI means you're an officially too big to fail organization and thereby protected by the government. And so the argument this was going to spread moral hazard all over the place because everybody would want to be a SIFI. It's not exactly.
Not exactly.
Yeah. Okay, the floor is now open. The usual rules of behavior here is that Princeton University students get priority. So if you're a Princeton University student and you want to ask a question, there's a mic at the bottom or towards the bottom of each aisle. And you're welcome to go first. I'm not seeing any takers.
After the last 2 days, there can't be a single student I haven't talked to.
You already. Yeah, you have made the rounds. Let's then just open it to the group in general, right here.
I'm sure you're aware there's an enormous amount of cynicism about government and its ability to deal with the problems you've been describing this afternoon, and especially the outsized influence of lobbyists. And there's been an effort to try to reduce government officials going to lobby firms soon after they've been employed by government. I understand that you left SEC and within 4 months joined a major lobbying firm.
And unjoined it.
And unjoined it.
Unjoined,
but
yes.
how can you reconcile that with this feeling of cynicism towards our government, toward our regulatory agencies?
Sure. So I'm happy to address the revolving door issue, but let me be clear. I affiliated with a financial consulting firm, not a lobbying firm. That firm doesn't lobby, and I certainly don't lobby. And actually, when I did it, I made a public statement that I would never appear before any federal financial regulatory agency on behalf of any client ever. So well beyond what the requirements are in the government's ethics rules. And so this revolving door issue is one that comes up a lot, and here's my view of it. I've spent 30 years as a regulator. I would love to have left the SEC and been a veterinarian. I just wasn't trained to do that, and I needed to work. So, and I think Sheila Bair would say the same thing, the FDIC chairman who recently joined Banco Santander on their board. But when I got to the SEC, we had great gaps in our knowledge and understanding, and we needed to recruit people to come into the agency to help us bring enforcement cases, to help us write the rules, and to help us understand what was going on. And I needed to bring those people in, sometimes from Wall Street, because those are the people who had the knowledge. If I told them they could never leave, they were never going to come. So my experience was when those people got on board, they were the most dogged and most aggressive about defending the public interest of anybody, more so than many of our great career staff were, because they understood why they were there, and they came because they believed in the mission. The ethics rules, now when those people go ahead and leave, there are ethics rules that prohibit appearance back before your agency for a period of time. And my experience was that when people left the agency and they went back into industry, they actually brought with them to their new employer an understanding about what the regulators were trying to accomplish, and actually an appreciation for what the regulators were trying to do. Not people who had secrets about how the regulators were going to operate. And so in some ways it can be a healthy thing. The ethics rules are particularly important. But my concern was that never actually that somebody I used to work with came back to the SEC to lobby. My concern was just with the pure volume of lobbying that was going on, and the inability for us to focus on getting our jobs done because we were dealing with so many meetings and so many demands from lobbyists to have meetings and to understand. So I understand the cynicism, but I actually think the revolving door is not the problem in many ways. You're welcome.
Tom?
Hi. Question about short selling, and more particularly about naked shorting. My understanding is, and I don't know this necessarily, but normally if you're going to sell short, you've got to be able to borrow the stock. I understand that during the financial crisis in particular, that certain institutions or hedge funds got advisory opinions saying as long as they were confident they could borrow the shares if necessary, they could short. So the question is that true? Did the SEC at the time know what was going on in enough detail? And did lax regulation of naked shorting allow certain people to pour gasoline on the fire, so to speak?
So I don't know what the SEC knew during the financial crisis because I wasn't there yet.
Right.
And I can tell you that there were a number of investigations of whether naked shorting had caused the demise, particularly of some of the larger financial institutions that had serious problems. And there was not sufficient evidence for the SEC to bring a case of that. When I first arrived at the SEC, you're really taxing my memory now. I hadn't thought about this in a couple of years. The agency had, just the year before, eliminated something called the uptick rule.
Right.
And we were under tremendous pressure to reinstate it. And in fact, we reinstated a version of it, the modified uptick rule, to try to deal with some of those issues. But I just can't really speak to what the agency knew about what was going on during the crisis.
I guess a more important question then is...
But you are supposed to borrow the stock.
Right. So I guess the more pertinent question is, could it happen again, or is a problem in that area?
I don't think we've seen problems. You see, periodically FINRA will bring a case for abuse of short selling. Periodically the SEC will, but certainly in my last 2 years at the agency, I didn't hear anywhere near the level of concern that I was hearing in my first year, for sure.
Good. Thanks.
Yeah.
Hi. So I have a question about, just in general, in your opinion, about academics' access to financial data, because there was a lot of lip service done, especially around the financial crisis, that it would be a really good thing to get more eyes on this, to have input. And so then a very bad thing within the last year, what happened with the CFTC. Are you familiar with their data program and how that got shut down?
Yeah, for lack of resources.
No, it's much worse. So they.
Well, I know they had data quality problems on the derivatives.
No. So with the CFTC, so they were allowing academic researchers then to have access to some of the data that would have variables and information that you wouldn't necessarily be able to get from some of the regular data. So for instance, like market book stuff, usually market book is derived, but they were allowing academics to have access to see how the orders were flowing through the system for different derivatives.
Yep.
So several researchers found negative things, pretty shady things that were going on. Looked like, you know, investors were getting a bad deal. The trading firms complained, and essentially, well, one, they got their PR hacks to basically make it like, oh, the CFTC was, putting out, with privacy issues, and affecting everybody's privacy, not saying, it was because they found all these shady things. And essentially that shut down, and now there's no access to that except for CFTC employees. But, they're overworked, and more eyes on it. So those are the only ones who are allowed to use that data now.
So I mentioned earlier that the SEC now puts enormous amounts of data on their website, and this new website that they just introduced a couple of months ago that I think is there particularly to encourage academic research on market structure and the quality of markets issues. All the regulators need to become increasingly data-driven, and we know this very acutely at the SEC, where we have an obligation to conduct cost-benefit analysis when we write rules. That those analyses need to be supported by data, and we in fact created an entire division at the SEC of risk strategy and financial innovation in order to bring in more economists and quants and analysts who can utilize data more effectively to support the agency in both enforcement and rule writing. I don't know the specific rules at the SEC around what data is public and what isn't, but my guess is that at least at the SEC, the view is that anything we can make public, we want to make public, because we want to leverage academia and private research with that data to help inform, do we go right or do we go left on this particular issue? So it's a very open environment at the SEC, I think.
Okay.
Yeah, unfortunately, it's open. Yeah.
I think we need to go on. Thanks. Thank you. Yes, ma'am.
Just a quick question, and I think it just reveals my lack of knowledge on this topic, but is Fannie Mae regulated? Or
No, so Fannie Mae and Freddie Mac are government-sponsored entities that are in conservatorship and are effectively very, very tightly overseen. They're not quite run by, but pretty close to being run by the Federal Housing Finance Agency. So they are post-financial crisis, when they were put into conservatorship, very highly regulated.
Let's go right over there.
Hi. Earlier in the presentation, or at the beginning of your talk, you said that the point of the SEC was to, one of the main purposes of the SEC was to increase transparency so that investors would have more confidence in the markets. What are your views on Bitcoins, which were specifically designed to decrease transparency? Because the playing field for investors in terms of Bitcoins is already even, and those who invest in it do know what they're getting into.
Well, maybe they do and maybe they don't, since we haven't heard from all of them. So, look, let me be completely honest with you. I'm a pretty big skeptic, and so everyone can be happy that I'm not responsible for regulating Bitcoin, because I don't fully understand it, and I think what we've seen happen with Mt. Gox shutting down, and people lost very significant amounts of money. What we see in how these things, whatever they actually are traded in terms of the volatility of the price, makes me incredibly nervous. And when we say we don't need to worry because everybody's sophisticated, the reality is anybody can get engaged in this, whether they're sophisticated or not. There will be problems, people will get burned, and I think it's the frontier, to be perfectly honest. But You know, maybe I'm just too old, and I can't quite wrap my head around Bitcoin, but I worry very much about fraud and scams. I worry about anything where there's no transparency in the sense that it's a black box that determines, you know, how many Bitcoin will be, and we don't even really know who's behind it, how many Bitcoin will be issued. That lack of transparency, that lack of accountability at the end of the day, I think is very worrisome.
Okay. Right here.
This is going back to Dodd-Frank and the time between writing the actual bill and it being implemented. So I was just wondering if you think that in the future we'll ever have a consolidation of the multiple regulators to be able to cut down on the time between, you know, writing the bill, you know, future bills, and then implementing those bills.
Well, so most of the legislation that comes out of Congress really doesn't require multiple regulators to get together and come up with a single approach. Dodd-Frank was a little bit unusual in that regard. But that said, your question is a good one because we have such a fragmented regulatory structure. We have 4 banking regulators. We have 2 capital markets regulators. We have an insurance regulator. We have a partridge in a pear tree. I mean, we have so many regulators who have different pieces of the financial markets, which is why the FSOC was created, to try to bring some cohesion to that. There's lots of political reasons why it's hard to eliminate a regulatory agency, not the least of which is different committees of Congress have jurisdiction over different agencies, and they like that jurisdiction. The Agriculture Committees oversee the CFTC. The Banking Committee and the Financial Services Committee oversee the SEC. So even though a lot of what we do is the same, we answer to different congressional oversight committees, and they don't want to give up their jurisdiction. So the Office of Thrift Supervision was eliminated in Dodd-Frank, but then the CFPB was created, so we didn't actually reduce the number of agencies. And I think it takes tremendous political will to reform the financial regulatory system to that great an extent, and I just don't see it happening anytime soon, maybe ever.
Let me just add a short codicil to your answer, which you were much too polite to mention, but being a member of one of the financial committees or the tax writing committees is a wonderful help to your fundraising activities when you run for office. Really wonderful.
Thank you.
Actually, I think you were here first, even though it's the same mic. Go ahead, and then I'll get you.
Hi, I was wondering what your response was to the criticism. I guess lately you've seen like punishment of some investment banks for the bad practices by, I guess, putting fines on them. And I guess a lot of people say that you're kind of hitting the shareholders twice there instead of kind of targeting the actual executives that were in power during those practices. So I was just wondering what your response to that criticism was.
Sure, that's a great question. It's one we wrestled with a lot. My charge to the Enforcement Division, and this was true before I arrived and true today, is that we always want to try to hold individuals accountable if we can. Sometimes it's very difficult because of the requirements of the law to meet certain legal standards, to be able, for example, to prove scienter if you want to charge fraud, because of the complexity of the way some of these financial institutions are organized. It's sometimes hard to find the person who is responsible for conduct. So you always look for the individual, but when you can't find pin accountability on an individual in a way that's legally sustainable, cases can also be brought against the institution. And our goal there is always, first and foremost, to try to get money back to harmed investors. I recognize that shareholders are also damaged, and shareholders are, in that sense, innocent bystanders. But the answer can't be that nobody is held accountable at all for the conduct, and that there's no restitution that's made to investors who are harmed. So we tried to be sensitive to the shareholder issue, but at the end of the day, the law has to be enforced, and that means sometimes the institutions are going to be held accountable for that.
Okay, thank you.
You're welcome.
Thank you. This will be the last question, please.
I wanted to follow up on that multiple regulators question. Could it be argued, though, that it provides checks and balances and perhaps multiple perspectives, and it may be messy, but maybe it could actually be helpful?
There's no question about that. And so you get an agency like the SEC that's a capital markets regulator and has a very particular perspective about risk, about disclosure, about enforcement, very aggressive civil enforcement agency. And you combine that perspective and that way of looking at issues with a bank regulator as more of a prudential, systemic approach to an issue. And the combination of those ideally should yield a better, more thorough look at whatever the issue is and perhaps a more comprehensive solution to that issue. So that's why I like the construct of the FSOC as a mechanism to bring all those perspectives together and look at a problem from a lot of different angles. And that's what FSOC has done with the financial crisis. We've tried to look at it. They've tried to look at it. I still say we after a year. Tried to look at it from, what was the role of derivatives? What was the role of hedging and market making and hedge funds in the crisis? What was the role of the banks, the money market funds that we talked about earlier? You get all these different perspectives from different expert regulators, and that is a good thing.
Well, Mary, thank you very, very much for sharing.